Good day, everyone, and welcome back to lesson number 18, which is interpreting financial results. So, under this lesson, we're going to be continuing with where we left off in terms of lesson number 16, where under lesson number 16 we talked about income statement part A, and then this is a continuation of that part, which is now part B. So, let's go in and see what this topic has for us today. So this is part of chapter 4, interpreting financial results. So here it says that what to read. So you need to go to your textbook on finance in media, fourth edition, page 200 to 206. This is what this unit or lesson will be covering. I've also included some of the recordings that you can go through in terms for this lesson. And then again, you need to attend class regularly, make sure that you participate. You also complete textbook activities covered in this lesson so that you are able to fully understand the concept and its application. So the lesson outcome for this lesson 18 is that you should be able to define the statement of profit and loss and other comprehensive income, explain the difference between gross profit, net profit, and cash on hand, discuss the causes of shrinkage, explain ways to minimize shrinkage, calculate increase and decrease in sales, gross profit, and then finding the missing figure in the income statement. So this will also be the outline of this lesson. So we've already covered on the previous lesson about the income statement, that it is a financial statement that shows the company's income and expenditure. It also indicates whether the company is making profit or loss. So it also indicates the profitability of the company or whether the strategy that the management of the company have decided to use as part of the business operation have paid off or not. So here it says that the importance of the income statement is to show whether the business owner can refer to this document to see if the strategy paid off, and it is also show the effectiveness of the strategy that the business set at the beginning of the financial period. So all of these have been discussed on lesson number 16, so I'm just gonna skip this because we already discovered this on lesson number 16. If you want to understand more of this, you can refer to lesson number 16. So now, under this lesson, the focus area will be now starting at the shrinkage to say that what is shrinkage and how can we avoid shrinkage in a business. So shrinkage is in an accounting term used to describe when the store has fewer items in stock than it is recorded in the books of an inventory. So when a simpler term, I would say shrinkage is when you recorded that you received 20,000 or two books, and then you did receive those two books, but when you go to your storeroom or when you try to sell books, you only discover that you're only left with one book. So that is what shrinkage is all about. So it means that you either lost the other one book, or you misplaced the book, or someone stole the book. So that is what all shrinkage is all about. So here it says that shrinkage mostly happen when there is stock involved. So it can be a production or sale. So whether you are buying and reselling the product, so there can be shrinkage, or whether you are producing the product in-house and sell it, so there will be shrinkage in those kind of environment. And shrinkage causes the company gross profit to go down. So how does it cause the gross profit to go down? So when you have got stock, so you will have a cost of purchases, and when that stock goes out of the business, we say that now you have what? Cost of sales. So for any stock that we do not have or that is stolen, we're gonna classify it as cost of sales, and then we're not gonna have any revenue for it because we need to take out that stock out of our books. So meaning that our cost of sales will be very high, and therefore our income will be less. So this will affect then our gross profit. So our gross profit will go down because of shrinkage. So types of shrinkage include theft, breakage, aging, absolute inventory, natural disaster, fire and storm, and others. So these are the most common type of shrinkage, to say that product might get lost or stolen. Some might break depending on how fragile they are. Some projects might age and then they might no longer be usable, and then they become spoiled. And then we also have got obsolete inventory, when an inventory becomes no longer useful on the current world or on the current environment because of technology, political, and fashion. So those are types of things that could happen over an inventory. Sometimes there will be natural disasters, floods, all of those things that could damage your inventory, and that inventory will have to be written off as cost of sales because we want to take out that stock. Sometimes we just end up scraping the inventory, trying to recover whatever we can by selling them at a lower cost or at a cost price so that we avoid running at a huge loss. So here it says that shrinkage, there are ways that we can actually get to minimize shrinkage by tightening the security inside your shop, which means that you will install surveillance such as closed circuit TVs, where you'll be able to monitor and people will be seeing that they are being monitored. They won't be able to steal. A record, keeping accurate record of all inventory movement. So meaning that whenever inventory gets to be moved from one place to another, you will actually get to track to say that on our system it shows that this inventory was moved from this point to this bin. So meaning that you need to keep track of every movement of inventory within the company. Provide adequate and secure storage facilities. So this is one of the method you can use to minimize shrinkage. Ensure that correct product and quantities are shipped to customers. So meaning that when you do this, meaning that you always check the stock that is going out compared to what was ordered or purchased by a customer, so that you avoid selling the wrong item to a customer, because sometimes you find that a customer bought a cheap product and is supplied a quality product, meaning that that will be a huge loss to the business. So therefore there are a number of ways to reduce shoplifting incidents, such as installing CCTV cameras, placing easy to steal item behind cashiers, neat shelf packaging, and many other more, so that you can reduce the shrinkage within the company's inventory. So this now brings us to the type of inventory system that you can use within your company. So depending on which industry you are in and whatever type of business you are conducting. So if you are conducting a business that also include inventory, so you will have either to choose between perpetual and periodic system. So where periodic system, I'll start with perpetual. So perpetual means that each and every time you get to sell an inventory, you'll actually have to record that inventory and update all your books. So information gets to be updated each and every time. And then we've got periodic system. So periodic system allows you to sell all your inventories, or you're just gonna sell all the inventory, and once the inventory is done, you will then you then go and record everything down and do your balances to see how much inventory is left and how much it is was sold. So periodic system mostly allows or applies to small businesses, and for bigger businesses you'll have to apply perpetual, so that you don't get to lose inventory, and keep track of your inventory, so that you don't get to lose customers. So here on the slide says the periodic inventory system uses an occasional physical count to measure the level of inventory and the cost of goods sold, whereas the perpetual keeps the track of inventory balance continuously, with updates made automatically whenever the product is or sold. So periodic inventory accounting system are better suited to small businesses and that have easy to manage inventory, or those with low sales volume. And business with large inventories, high sales volume, multiple retail outlets need perpetual inventory system. So the cost of goods sold, it is an important accounting metric which when subtracted from revenue shows the company gross profit or gross margin. So depending on the two types, the perpetual and the periodic, you will still apply some certain method or techniques that are also used within there, to say that for each and every inventory that we have, let's sell the first stock that came in, and then lastly sell the stock that last came in. So you're going to be using what we call the FIFO method, first in first out. Sometimes you go and say no, let's just sell them the way they are, let's just mix them up. So you're going to be using what we call weighted average method. So there are methods that you can apply still within the perpetual and periodic system. So for you to calculate the inventory or the cost of goods sold, either you're calculating, sorry, closing inventory or cost of goods sold. This is the method that you are going to follow to calculate cost of goods sold. So cost of goods sold will be made by the opening inventory you had plus any purchased inventory that was purchased plus the transportation cost that you get to spend on when you bring the inventory from the supplier to your warehouse or to your store, plus the import tariff if you imported from outside the country, custom duties as well. So all of these added together gives you the cost of purchasing or cost of product of an inventory. So therefore, we're going to have your opening plus your purchases and all the other cost, then less the closing. This means that the difference in between the opening and the purchases and the closing will therefore give you what we call the cost of goods sold. Then if you want to calculate the closing inventory, you're going to have your opening plus your purchases in purchased inventory minus the one which are for the goods sold. This will give you the closing inventory. So here it says that under perpetual inventory system, the cost of goods sold is calculated the same way but for each transaction. So under perpetual, the only difference between this is that under periodic, you're going to do this at the end of the month or in the end of the period. And then under perpetual, you perform this manually. So these days we have got accounting system that uses perpetual that does everything for you. And then if your system you set it accounting system you set it to periodic, it won't tell you the balance of the inventory until the end of the month if you said that the periodic should be done monthly. If it's annually, then it won't tell you until the year end. So meaning that you will not know until you go and do a stock count. So the perpetual system keep tracks of inventory balance continuously. So this is done through the point of sales computerized systems such as your QuickBooks, Sage 300, Xero, and many others systems that are used to actually get to monitor inventory. So in terms of perpetual and periodic system, these are the key difference is that recording method, perpetual uses computer and softwares that are automatically updated and the company's ledger with information about the product that are sold and the remaining inventory, whereas periodic system through requires manual recording where you're going to do physical stock count. And then the margin of error, there is a greater chance of error when periodic is used compared to when it's perpetual is used because perpetual keeps you updated. Effort. Companies aren't required to put too much effort with perpetual system once the software and related infrastructures are installed compared to periodic where you are required to actually go and do a physical stock count to say how many items are remaining and does this compare to how many you sold and how many you actually borrowed in within the company. In terms of cost of goods sold, there are no continuous entry under the cost of goods sold associated with the periodic inventory system as there are with perpetual system. Rather, it is calculated using the lump sum at the end of the interval when count is conducted. And then this brings us now to what we call shrinkage and inventory count. So under perpetual inventory system, the trade inventory account should at all time reflect the value and quantity of stock on hand. So meaning that at the end of the period, it becomes easier when you're using perpetual system to be able to know how many inventory is left. So when you go there to count, you count with knowing that this is the value that I'm actually looking for. But however, it might happen that at sometimes the inventory becomes stale or damaged or stolen. So meaning that the system might reflect something that is not relevant to what is there. Because the system will only know that, okay, we had 20 items and then in stock, but you find out that out of those 20 items 5 were spoiled or damaged. So therefore when you go do a stock count, you will finally find 5 items, 15 items that could be sold. So meaning that you will need to update the system. So those are the only shrinkage that you can get under perpetual inventory system. Then under the periodic, this is where you get at the end of the month, you go and do stock count, hoping that everything matches up with what you actually had at the beginning and what you actually get to sold. But there will be also be spoilage, and this is where it becomes tricky, or some of them get stolen. So this is where it becomes tricky when it comes to periodic, because you are not aware of how much stock is left until you actually get to go to the storeroom to pick up the item that the customer is looking for. So here it says that physical inventory count will reveal any discrepancy between the value on hand and the estimated value according to the system under the trade inventory account. So the system value indicate the best case scenario where there is no shrinkage in inventory account. So if the inventory counts reveal discrepancy, such deficit will be recorded as a loss undertaking. So to indicate such discrepancy, therefore, cost of sales account will be debited, to say that if there is a difference on what the current system is saying and what is there on hand in terms of the warehouse. So he said that the system said that there's 20, the warehouse says there is 15. So therefore, when you go to the warehouse and count and find that there is 15, so meaning that there is 5 items lost. So those 5 items lost, the value of those 5 items will be debited to the cost of sales, meaning cost of sales will be going up and our revenue will be staying the same. So we get to suffer a lower gross profit. So an example will be, see page 4, which is say example number 4E on page 203, which is explaining more about shrinkage in a business environment and how it affects the gross profit. So there is a class activity which I'm gonna leave it to you guys as a homework as well. So please take a look at class activity 4E, for activity number 4E on your 4F on your textbook, which if you find any challenges, you can please email me and then I'll be able to assist you. And you can also perform number 4G, which is part of continuous assessment in terms of shrinkage and inventory, which if you master the two, you will be able to understand the concept in terms of the income statement, shrinkage, as well as the difference between the net profit, gross profit, and the operating profit. So all of these you will understand the terminology, as well as to understand the concept that when item get lost within the business, this item get to be recorded in the cost of sales, so that we can get rid of them from the trading account, inventory account, so that our inventory account should reflect the right amount of stock. So therefore we go and say we actually convert this into cost of sales. So we move the value of those amount from our inventory account to cost of sales. And then our revenue stays the same because we didn't sell those items, they were just stolen. So this brings us to the end of our lesson. So our next lesson will be interpreting financial result, analysis of financial statements. So that will be it for today. So please enjoy the rest of your day, and we shall meet on our next lesson, which is analysis of financial statements.